Hi, everyone. Welcome to another episode of Triathlon Partners TV. Thank you for joining us. First of all, look, what's going on? Oh, look, swag. Yeah, hey, fantastic. Triathlon Partners swag. If you'd like some, please visit our website, www.triathlonpartners.com, and we can arrange for you to look as awesome as I do right now. Now, thanks again for tuning in. If you're a big fan, I know a lot of you are, please, we'd love it if you could subscribe to this channel, as well as on the other social media posts, the likes, the thumbs up, the hearts. We love it. It really helps us, makes us feel great that we're making a difference out there in the financial education of investors out there. So now we'll get into the nitty gritty. This episode, we're going to be talking about interest rates and how we can use that to diversify our portfolios right now, because I know a lot of you are looking at the newspaper, seeing the Dow Jones and the S&P 500 making all-time highs, and you're a little bit reticent about putting money to work straight into the equity market. You might want to be a little bit more tactical and decide, well, when to put the money in the equity market, but what do you do until then, right? Well, there are a lot of options, and we're going to go into them right now today. Now, first ones we're going to talk about, we'll go through it very quickly, are traditional fixed income products. We're talking about money market, CDs, U.S. Treasuries, and then corporate debt. Well, the first three are all somewhat backed by the U.S. government, right? In terms of the amounts, the U.S. Treasuries, the government's going to pay. We're talking about the CDs or the money market funds. The CDs are definitely going to be FDIC insured. The money market funds, not so, but I don't really think the federal government's going to let a money market fund go belly up. That'd be quite problematic, as well as money market funds are very concentrated on short-term lending. It'll be very unlikely that someone would be exposed to that bankruptcy. But when we look at that, those things, the 10-year Treasury and the one-year CDs, they're about 4.25%, 4.5%. So on average right now, and that's great. But because there's little risk, that's going to be the floor of where we're looking in terms of the returns on the traditional fixed income. Now we could step up, and we have a mixture. We got some corporate debt from high-grade corporates. Top-notch corporates, they're going to average something like about 5%. And then we have something like high yield, or what's called junk. Those are companies with not such great credit rating, and they're going to be paying something a little bit like 7%, a little bit higher, right? So we sort of understand that's a great way to understand the risk-return matrix or dynamic that goes on in the bond market. But there's something else, and we've talked about it before on our episodes, called a MYGA, multi-year guaranteed annuity. These are something that insurance companies issue. For instance, right now, there's a 6 to 10 year area that the money is committed for. And you can earn about 5.5% on that. And the great thing about that is if you don't take the money out of the product, that money compounds in the MYGA without paying taxes until you withdraw it at the end of 6 or 10 years, however long the annuity is that you purchase. And the great thing about the MYGA as well, if it's under a certain amount of premium you've put in, they are guaranteed by the state regulators, depending upon what state you purchase the annuity in, which is great. So it's kind of like a bank CD that the federal government insures. This is something that the state would insure. So at 5.5% for that type of protection versus you're talking about 4.25% to 4.5% for those protections of the federal government, this is far away a superior product to get involved in. All right, so that's great. And now I wanted to touch upon traditional equity products that have that income stream, and that income stream is called a dividend. Now, there's several types of products here, and we're going to talk about the range of them. Now, there are some funds that specialize in investing in companies that seem to have a growth of their dividend payment or dividend yield over time. And there are a lot of companies like that, and that is obviously called dividend growth funds. And those dividend growth funds are paying like 2.25%, 2.5%. It's on the lower range of the equity spectrum that we're talking about. And you have to keep in mind the S&P 500, which encompasses a lot of companies, and some of them do not pay dividends, is more around 1.5% on what they pay, a little bit lower right now at 1.25%, but 1.5% is a good long-term average to use. So the next step would be companies that are really committed to been paying dividends for a long time, and they're somewhat substantial. Maybe we'll call them high yield dividend funds, and they're paying something more like 4.5%. Right. So we're getting to a point where, hey, that's kind of the same as the bonds that we were looking at from the federal government. Now, these are equities, and if you're concerned about equities going up and down, maybe this isn't a right choice for you. But these types of stocks who are paying that dividend tend to be less volatile than traditional equities. So you'll still get an appreciation, most likely, if the S&P 500 is going up. You'll get a depreciation of those stocks if the S&P 500 goes down, but not as much as the underlying index. It's sort of like a hybrid of between earning that yield from the dividend and total stock market exposure. Now, the next category I like to call derivatives income, right? So they're not paying, it's not the companies or the stocks that are actually paying the dividend. There's a fund or ETFs that pay you a dividend, and they get that cash from selling options against the underlying companies, right? So this has a very low correlation with the market. In fact, it could at times have a very negative correlation, because when the market goes a little bit crazy and volatile, option prices go up, and they're able to take advantage of that and sell and get some extra premium that they pay the shareholders back. It's very option related. There is some room in your portfolio for this, and these things do range between 7 and 10% of annual yield or annual dividends that they do pay. Some of them go on hot streaks, and which is great. So a little bit of diversification in the space is also very good. Now, there are two other products that I want to talk about, and one of them will go in first. Is called preferred shares. Preferred shares are a hybrid product between fixed income and equities. It has to do with where they align in the capital structure in case a company goes bankrupt. And they pay a dividend. Now, usually these stocks don't have a tremendous amount of fluctuation with the market, but they do. And most of the companies that do issue preferred shares are financial services companies. So you have to keep that in mind if that's an exposure you don't want to have. But again, they're yielding about 6%. And from that standpoint, that's pretty good, as well as these shares, the dividends are qualified, and that means they're taxed at long-term capital gains rates. And when those rates are as high as 20% for the highest bracket, as opposed to dividends that are taxed at income levels, the highest rate there is 37%. So you get to keep more of your money on an after-tax basis. And as well as another category we'd like to talk about is REITs very quickly, real estate investment trusts. REITs, number one, there is no double taxation. So a company would usually have to pay taxes on their earnings, then pay dividends, and then you pay more tax on those dividends, right? Instead, REITs don't pay taxes on their dividends. They don't pay taxes at all. But they're required to pass 90% of their earnings onto the shareholder, and then the shareholder pays the taxes on it. So there's more money for the dividends, which is great, and then you pay it. As well as some dividends are qualified, which means the same like preferred shares. They get taxed at capital gains rates, which are lower than income tax rates, which is fantastic. There are also access to the depreciation to reduce income, which is very popular in the real estate field. So that's something to consider as well. So hopefully that gave you a good spectrum of the different rates that fixed income products are earning right now, as well as a definition and an understanding of some products which aren't well talked about, lack of education in the markets that do offer great terms, whether some government backing like the MIGAs, some tax advantage like the REITs or the preferred shares, as well as the derivative income, which is a different way for companies to, for funds to generate income for their investors, right? They're taking advantage of things in the capital markets where they are able to sell options. So that's great. Now, thank you once again for tuning in and watching this episode. I really hope this provided a nice, solid foundation for your financial education, because that's what we're about at Triathlon Partners. We're about engagement, education, and empowering our clients to make the right financial decisions that best meet their objectives. And thank you very much. Have a very blessed day, everyone. Bye-bye.